Most investors treat SEC filings like boring compliance paperwork that only lawyers or auditors need to read. They see a massive wall of legal text and assume it has nothing to do with making actual investment decisions. But here's the thing. Ignoring these documents is a massive mistake because they serve as the company's internal blueprint. The law forces management to publish many of its secrets, and the real challenge isn't that the information is too complex, but rather that there is just too much of it. If you don't know which 5 SEC forms actually move the needle, you will drown in data and miss the risk signals that matter. You end up reacting to news headlines instead of seeing major shifts weeks or months before the rest of the market. Today, we are going to cut through that noise. We aren't going to waste time listing every obscure form in the database, but instead, we will identify the 5 specific filings that should become your core due diligence toolkit. First, start with the 10K, the company's annual report. Serious investors should not approach it as a routine financial recap, but as the market's most complete management-authored disclosure of how the business actually works, where it is vulnerable, and what may shape future results. One section that deserves especially close attention is Item 1A, Risk Factors. This is not boilerplate to skim past. It is a legally required account of the risks that could impair the business, pressure margins, disrupt operations, weaken demand, or constrain future growth. Read carefully, it offers a revealing map of the company's underlying fragility. That said, sophisticated investors do not stop there. MD&A, or Management's Discussion and Analysis, is critical because it explains the drivers behind reported results, highlights trends management wants investors to focus on, and often signals where performance may be strengthening or deteriorating beneath the surface. The business section is equally important because it clarifies the company's operating model, revenue drivers, customer base, and competitive positioning. And the financial statements with accompanying footnotes often contain some of the most decision-useful information in the entire filing: debt maturity schedules, lease obligations, stock-based compensation, segment economics, legal contingencies, revenue recognition policies, impairment charges, and other accounting judgments that can materially affect how the numbers should be interpreted. In other words, the 10K should be read not as a static summary of what happened last year, but as a detailed primary source for assessing business quality, financial resilience, and the credibility of the company's long-term investment case. Second, turn to the 10Q, which gives you a more current read on how the business is evolving between annual filings. For investors, its value lies less in rereading familiar headline numbers and more in identifying what has changed since the last quarter. The key is to read it comparatively. Look for shifts in management's language, emphasis, and level of confidence. When executives begin to qualify prior optimism, spend more time explaining margins or liquidity, or change how they frame customer demand, inventories, or near-term conditions, those edits can signal that something important is moving beneath the surface. The 10Q is especially useful because it captures developments in real time. It can reveal emerging pressures before they become obvious in the full-year story, whether that means slowing orders, deteriorating pricing power, rising costs, operational disruption, or balance sheet strain. Pay close attention to newly disclosed legal matters, changes in share count, updates to guidance-related language, and any revisions to segment performance or capital allocation priorities. Strong investors use the 10Q not just to monitor results, but to detect narrative drift early, before the market fully prices in what management is beginning to acknowledge. Third, pay close attention to the 8K, which serves as the market's real-time filing for material corporate events. For investors, its importance goes well beyond earnings releases. The 8K is often where the earliest signs of disruption, governance stress, or unexpected strategic change first become visible. In other words, it is one of the fastest ways to see what has changed before that shift is fully reflected in quarterly or annual reporting. Certain items deserve especially close scrutiny. Item 4.02, which relates to non-reliance on previously issued financial statements, can be a serious warning sign because it suggests prior reporting may no longer be trustworthy. Item 5.02, covering departures or appointments of directors and senior executives, can also be highly revealing, particularly when leadership changes appear abrupt, poorly explained, or tied to broader internal instability. Investors should also watch for disclosures around major acquisitions, asset sales, restructurings, debt agreements, impairments, or regulatory events. The 8K matters because many of the market's most important non-financial signals appear here first, often well before the full implications are reflected in the stock price. Fourth, review Form 4, which discloses when corporate insiders, such as executives and directors, buy or sell shares of their own company. For investors, this filing can offer a useful read on insider behavior, but it needs to be interpreted with context and discipline. A single sale on its own usually means very little. Executives sell stock for all kinds of personal reasons, including diversification, tax planning, or liquidity needs. What matters more is the pattern. Repeated selling across multiple senior executives, especially in close succession or during periods of elevated valuation, can be worth paying attention to. At the same time, insider buying is often more informative than selling because open market purchases involve executives voluntarily committing personal capital. Investors should also distinguish between discretionary trades and sales, made under Rule 10b-5-1 trading plans, which are prearranged and therefore less indicative of a fresh view on the business. Form 4 is valuable not because it offers a perfect signal, but because it provides another layer of evidence about how the people closest to the company are behaving relative to the story being told publicly. Finally, you need to pay attention to the Schedule 13D. This filing appears when an investor buys more than 5% of a company with the intent to be an active participant. The section to read most carefully is the purpose of transaction. That is where the filer explains what they may want to do with the stake, whether that involves pursuing strategic alternatives, board representation, changes to capital allocation, operational improvements, or even a sale of the company. These disclosures matter because they can introduce a new catalyst into the investment case, one that the market may not yet fully appreciate. A 13D does not guarantee that change will occur, but it can provide an early, highly credible window into what may happen next and which pressure points within the business are attracting activist attention. Your action plan needs to be systematic, so you should treat these 5 documents as a permanent monitoring system for every stock in your portfolio. First, you need to read the risk factors in the 10K to set a baseline for what the company fears most. When the next 10Q comes out, you can scan the management discussion to see if their language has shifted away from that original baseline. You should also set a simple alert for new 8K filings and skim them specifically for items 4.02 and 5.02, which cover accounting errors and executive departures. Instead of worrying about single transactions, check Form 4 filings once a month to look for clusters of insider activity. Finally, you must always verify if a new 13D has been filed to see if a major activist is moving in. This process turns static data into a dynamic tracking tool, which means you can stop guessing about a company's health. You are now tracking a legally reported trajectory the same way regulators and major institutions do. You aren't just reading reports anymore because now you are auditing the narrative. Visit secfilingdata.com to see our forms page for filing trackers for the Form 10Q, 8K, Form 4, 13D, and 10K.